Hi, welcome to another video in the AS A-Level Managerial Accounting series. This is the second part of the budget chapter. I hope you've already watched the first part where we've discussed some types of budgets. We've seen some examples. In this video, we will see some more types of budgets and also some examples. So we've already covered the definition of budgets in the previous video, and then we covered the sales budget, production budget, purchase budget, trade receivables and trade payables budgets. These were already covered in part 1. So if you've not watched that video, I will suggest go and watch that video first. And in this video, we will look at cash budget and master budget. So what do you mean by cash budget? Cash budget shows the expected receipts and payments in form of cash or bank or to the bank during the budget period that the business expects. And also the cash budget will show the opening and closing balances. So if you're preparing the budget for a 6-month period, so opening balance for that period and the closing balance of cash or bank for that period. So this is what is shown by a cash budget. If you look here at the format of the cash budget, first part will show the receipts that are expected during the period. So for a business, receipts can come in form of cash sales, cash collected from debtors if the business is selling on credit, loan can be taken from bankers or from any other lender, any asset can be disposed and cash can be received for that. So receipts can happen in various forms. All these receipts will have to be listed here. Then the second part is to list all the payments. Payments will be in form of cash purchases or payment to creditors if the goods are already purchased on credit. Then operating expenses have to be paid. Non-operating expenses like interest may have to be paid. Repayment of bank loan or capital expenditures can happen during the period. So all these will be come under the payment section. And then finally, we list down the net receipt or payment, which is equal to the receipt minus the payment. If it's a positive amount, if receipts are greater than the payment, it will be written as a positive number. If the payment is greater than receipt, then it will be written as a negative number or in brackets. So this row will show the net receipt and payment. Then we will consider the opening balance of cash and bank at the beginning of the period. Once we take up the net receipts payments along with the opening, what we get at the end is the closing balance, and that is a very important part of the cash budget because every business wants to know that during the budget period, how much will be our expected closing balances of cash and bank. Because if let's say this figure is a positive amount and if it's a very high positive amount, then it means the business is going to have a lot of surplus cash during the budget period. So what it can do is it can look for some temporary investments or some other way to use this cash more efficiently in the business. Or another situation can be that this amount is a negative amount and maybe it's a big negative amount. So what can happen is the business can start looking for sources of funding, maybe through bank overdrafts, through long-term loans, depends, even before they go into negative cash. So it helps both ways. So that's the purpose of preparing the cash budget. Now let's have a look at an example of cash budget. It is one of the questions from past papers of Cambridge board. So Luke's business is due to start on 1st April, selling a single product. The purchase price is $40. Okay, this is important for us. And then Luke will sell each unit at a markup of 60%. So if they buy for 40, add up a markup of 60%. So selling price will be $40 plus the markup 60% of $40, 24, $64. He also wants to maintain an inventory at a level sufficient to cover 50% of next month's sales. So let's say they're talking about April. At the end of April, they want 50% of May's sales to be kept as finished goods inventory. Budgeted sales for next 4 months, April, May, June, July are given. What we can do now itself is we know the selling price and we know the units that will be sold. So we can try to calculate the sales value, which will be 5,000 into $64, 8,000 into $64, 4,000 into $64, and I don't think July will be needed because here they're telling you prepare the cash budget for April, May and June. So let's First calculate for these 3 months, April, May, June. The sales value 5,000 into 64, $320,000. Then for May it will be 512,000, and for June it will be 256,000. So we've calculated the sales value. We've just calculated sales value. Don't think that this money is being collected and this will appear as receipts in the cash budget. No, collections can be different from actual sales. So for that, we'll have to see the collection pattern. Okay, let's read further. Luke will introduce 150,000 capital into the business bank account. This is clearly a receipt for the business. So we will put this under receipt. On the same day, equipment costing 48,000 will be purchased by check. So this is clearly a payment because it will be paid by check, the entire amount. Sometimes it can happen that they buy an equipment but it's on credit. That will not appear in the cash budget. Only actual receipts and actual payments. Equipment will be depreciated over a period of 60 months with no residual value. Basically straight line method and divided by 60 months. So 48,000 divided by 60. That's how we will get our monthly depreciation. Though depreciation as such doesn't appear in the cash budget because it's a non-cash item. Let's see, if we need it later, we will find the value and use it. All purchases are expected to be paid 1 month after the purchases are made. So if they buy in April, they are going to pay the entire value in May. This is important when we prepare the cash budget. So when we're talking about the payments for the purchases or payment to suppliers, we will see what was bought in the previous month that will be paid in the current month. All sales are on credit. 20% of customers are expected to take a cash discount of 1.5% and pay in the month of sale. So let's say in April, whatever sales are done, 20% of the sales will be collected in April itself, but after the customers are allowed a discount of 1.5%. Then 30% of April sales will then be collected in May because it says 30% are expected to pay 1 month after sale and the remaining are expected to pay 2 months after sale. So 50%, 20% in April done, 30% in May done. So remaining 50% which are not yet collected will be collected in June, 2 months after sale, which comes in June. So this is the collection pattern that we will be following. Monthly operating expenses will be paid in the month they are incurred. Very simple. We'll directly write it as payment of expenses. They are expected to be 43,000 including depreciation. So 43,000 is including depreciation. We have to see how much is the operating expense excluding depreciation because depreciation cannot appear in the cash budget. So 48,000 divided by 60, if I calculate 800. So the net, I would say cash expense, the amount that is paid in cash for operating expenses, 43,000 minus 800, 42,200. This will be used in the cash budget. So prepare a cash budget. Let's first write down the overall format of the cash budget and then we'll see some workings and then finally put all the amounts in the cash budget. First, we begin with the receipts in the cash budget. Under the receipts, we have adjust for the point number 1 here, capital introduced. So capital, and it is introduced on 1st April. So we are going to write the amount in the April month, 150,000. Nothing in May and June. Then what other receipts can we have for this business? Collection from customers. So receipts from customers. Now receipts from customers, I will divide it into 3 parts. In the month of sale, one month after sale, and 2 months after sale. Basically 20% in the month of sale, 30% 1 month after sale, and 50% 2 months after sale. If you don't want to do this here in the cash budget, you just want to write it as a single line item, that also can be done. Then you have to do this as a separate working note, and then you can present the entire collection from customers as a single line item. That's also fine. We don't know the amounts yet. Let's calculate that later. We're just preparing our overall format, listing down whatever receipts and payments we can have in this. Then payments. So under payments, we have payment to creditors for the purchases. It's just simply 1 month after purchase. So we just need one row for this, nothing else. Payment of operating expenses. Then we also bought equipment. Equipment, we already know the amount. It was bought in April. So 48,000 in brackets I'm going to put. Also payment of operating expenses, let me fill it now only. We've already calculated the amount. So 42,200 minus for all the months. Because if you read the adjustment number 5, it says they are paid in the month in which they are incurred. So same amount every month. So here we are still left with the payment to creditors. We need to calculate that, then only we can get the total. Finally, at the end, we have net receipts or payments. To this, we will add the opening balance of cash or cash equivalents or cash or bank. Then we will get the closing balance of cash or bank. So let's start with our working so that first we can calculate how much was collected from customers. We've already calculated the sale value. So sale value for April, if you see, is 320,000. Let's do a working for this so that others, even if I don't do it in detail, you can do it on your own, you'll understand. 320,000, let me bring it down here, 320,000. I will break it down into 3 parts, 20%, 30%, 50%. 20% was collected in April, 30% was collected in May, and 50% was collected in June. This is April sales. 20% was collected in April, so 20% of 320,000 works out to 64,000. But this was collected after deducting 1.5% cash discount. So this I'm going to multiply by 98.5%. So I get 63,040. This was collected in the month of April for April. Then in the month of May, 30% of 320,000, 96,000 was collected. And in the month of June, 50% of 320,000, 160,000 was collected. So what I can do is I can go to my table, cash budget, receipts from customers in the month of sale, 20%. Under April, I can write 63,040. Then 30%. In the May column, I can write 96,000. And 2 months after sale, 50%. In June column, I can write 160,000. So that completes my analysis of just April sales. Same thing I have to do for May and same thing I have to do for June. So this was just for you to understand how to do the calculations. Now I'll just do a brief working so that you can use that even as a presentation in the examination. So in exam, you'll have to present your working, right? So I'll just draw a quick table here so that you understand how to present the working in the exam also. So let's do a working here, working notes, collection from customer. We'll prepare a table. So April, May and June. Let's write down the sales in each of these months. All amounts are in dollars. So sale was 320,000 in April, 512,000 in May and 256,000 in June. So how much was collected in the month of sale? Basically 20%, subject to 1.5% cash discount. So 320,000 into 20% into 98.5%, we've already calculated 63,040. You can do the calculations for other months on your own so that you also get confidence in this. Collection 1 month after sale, 30% of 320,000, 96,000, and collection 2 months after sale, 50% of 320,000, 160,000. So that completes April. Same way you'll have to do for May and June. So for May, 20% of 512,000, but subject to 1.5% cash discount, or multiplied by 98.5%. So we get 100,864. And 30% of 512,000 is 153,600, and 50% of 512,000 is 256,000. Then 20% of 256,000 into 98.5%, 50,432. 30% of 256,000, 76,800, and 50% of 256,000, 128,000. So we've calculated that these are the months in which goods were sold for so much value. When is their collection due? That we've calculated. Now we are going to put it in the cash budget. The first month we've already done it in the cash budget, April month. So these three amounts have already been written here. Let's do it for May and June also. For May, collection in the month of sale is 100,864. So I'm going to go to the May month, and collection in the month of sale 100,864, and collection 1 month after sale is 153,600. So here 153,600. Collection 2 months after sale is not applicable because May month collection 2 months after sale happens in July, and we are not preparing cash budget for July. We are preparing for only April, May and June. Now coming to June month. So from May we've used these two amounts. Now coming to June month, 20% collected in the month of sale, 50,432. So we are going to go here, 50,432. So that completes our collection from customers. Okay, let's continue. Then coming to payments, our payment to creditors is still remaining. How will you calculate payment to creditors? Only when you know the purchases, because payment to creditors is done 1 month after purchases. But in this question, purchases are not given. The quantities that you see here, April, May, June, 5,000, 8,000, 4,000 and 3,000, these are sales values. You don't have purchases yet. So you'll have to calculate the purchases. In the purchase budget part, we've seen that when preparing the purchase budget, you can calculate your purchases by starting with your sales, adding the closing inventory and subtracting the opening inventory. So we are going to do exactly that. Coming down, let's prepare our second working note. Calculation of purchases. April, May and June. So we start with the sales units. How many units were sold? 5,000, 8,000 and 4,000. To this, add the closing inventory. And if you read the question, how much closing inventory do they want? They want closing inventory to be 50% of next month's sale here in the second row. So going back to this, in April, they would maintain 50% of May month sale as closing inventory. 50% of 8,000 is 4,000. May month, they would maintain 50% of 4,000, which is 2,000. And in June, they will maintain 50% of July sales. If I go back up and see July sales given is 3,000. So they will maintain 50% of that, 1,500. less opening inventory. Closing inventory of previous month becomes opening inventory in the current month. Last month there was no closing inventory. This is the first month when business is starting operations. In May, opening inventory 4,000. In June, opening inventory 2,000. So let's calculate the purchases in units. 9,000, 6,000 and 3,500. Now we will calculate the purchases in dollars in value. And how much is the cost of purchases? They've mentioned on top itself that the purchase price is $40 per unit. So we just have to multiply the purchase volume with $40. So 9,000 into 40, $360,000. 6,000 into 40, $240,000. And 3,500 into 40, $140,000. This is the value of purchases done in the month, but it is not, this amount is not paid in that month. This amount is paid in the next month after purchase. So this 360,000 is actually paid in May. This is paid in June, 240,000. This is anyways in July. We are not concerned. We are only preparing cash budget for April, May and June. So to payment to suppliers, we're going to put May and June column 360 and 240,000. Nothing in April because nothing was purchased in the previous month. 360 for April written in month of May and 240 for May written in the month of June because payment is in the month of June. Now we're going to take the total of the receipts and payments for each of these months. Okay, for April, the total of receipts 213,040, 196,864 and 364,032. And doing the payments total also 90,200, 360,000 and 240,000. I'm going to put it in brackets, and 400 to 200, 282, 200. Now calculate the net receipts and payments. So 213,040 minus 90,200, positive amount 122,840. So that's a net receipt. For May, it will be 196,864 minus 402, 200. Clearly payments are higher than the receipts in this month. So it's a net payment. So in brackets 205,336. And for June, again it's a net receipt 81,832. Next step is write the opening balance. No opening balance in April, first month of business. In May, the opening balance will be the closing balance of April. So let's also calculate the closing balance of April. Then only we can come to the opening balance of May. So closing balance of April becomes 122,840 itself because no opening balance and net receipt is 122,840. Basically, we are going to add these two to get the closing balance. So opening balance in May becomes 122,840. To get the closing balance of May, we will have to add these two. Since payment is negative and opening balance is positive, net becomes a negative value of 82,496. What does a negative balance here show? It shows that possibly there would be a chance of bank overdraft for this business in the month of May or by the end of month of May. And then going to June, opening balance is minus 82,496. The net at the end of June is minus 664, the closing balance. And we get this by taking a total of these two. So that completes our cash budget, and I hope you've understood how to prepare a cash budget. Obviously in exam you can get questions where adjustments are much different than what I've done here. So it all depends how much practice you do for this particular chapter or for this particular concept of cash budget. The more you practice, the more adjustments you'll be exposed to, and in exam you'll not have a problem. And finally, we have the master budget. A master budget is prepared by summing up or aggregating all the departmental budgets that we've seen. We've seen the sales budget, the production budget, the purchase budgets, then there can be labor budgets, then there is cash budget. All of this when compiled together, and along with that budgeted financial statements when we present, that entire set is called the master budget. So master budget is prepared by aggregating all the data from individual departmental budgets to show or to understand what is happening at the organizational level during that budget period. So what are the contents of master budget? It includes all the departmental budgets that we've studied till now, cash flow forecasts, budgeted financial statements that can include the income statement, balance sheet, maybe cash flow statement also if a business wants to include. Then list of capital expenditure or budgeted capital expenditure that are going to happen, and any other document that will present the financial plan of a firm, that will also be included under the master budget. We are not going to do an example on master budget because we've already seen these departmental budgets anyways. Apart from that, you can have in exam the preparation of budgeted financial statements, which is not different from how you prepare your original financial statements. It's the same thing. So if they tell you to prepare budgeted income statement, it's like preparing the original income statement just with budgeted numbers, budgeted figures. So I don't think there should be a problem there. So I hope you've understood the budgets chapter now. This video along with the previous video will make sure that at least now you know the basics of budgets, at least how to approach the question that is given. Obviously, just watching these two videos on budgets, you will not be able to solve all the questions on budgets that come up in the exam. You'll have to practice. So once you watch these videos, you can practice at least 10 to 12 questions on budgets, and then you will realize that okay, whatever adjustments come up in the question, you will be able to handle them, because once you solve 10 or 12 questions, you more or less try to cover most of the adjustments that are possible in the budget questions. So if you enjoyed the video, please like the video, please share the video with your friends, please subscribe to the channel, and I will see you in the next video.